following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, and welcome back once again to the Advisor's Option. This is, of course, the program where we break down options concepts for you, the busy advisor and asset manager who is interested in learning more about this marketplace and in trading these products and adding them to your portfolio, but are perhaps overwhelmed or intimidated by the sheer volume of information available out there and the somewhat intricate nature of these products, or at least the perception of them being very intricate and complex. We mean to dispel a lot of that here on this program. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And joining me on the Advisor's Option today, first up, we have my co-host, my partner in crime. He is the co-founder of Swan Wealth Advisors out there in sunny and scenic Colorado. He's none other than Randy Swan. Randy, welcome back to the program, sir.
Thank you, Mark. It's been a good week to join you here.
Yeah, I hear you had to actually, even though you live in Colorado, you had to trek a good distance to do some skiing this year.
Yep, I took some clients and myself up skiing up in Canada last week, and the powder was great, the weather was okay, but overall it was a fun time.
You know, global warming is creeping in when you have to fly 1,000+ miles from Colorado to get some good skiing in.
Something like that.
All right, and also joining us on the program today is Alan Grigoletto. He is the Director of Education over there at the Options Industry Council. Alan, welcome back to the program, sir.
It's a pleasure, Mark. Thanks for having me again, and good to be on the show with Randy again.
Well, it's a fun show. We love doing it here. We wish we could do it more often because there is such demand out there these days from the advisors and from the active asset managers and everyone really reaching out to us over here at the OptionsInsider.com and the Options Insider Radio Network looking for more information for that specific segment of the audience. So, as usual, we're happy to oblige them and provide it here on the Advisor's Option. And now, without further ado, we're going to roll into our first segment, our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to our Options 101 segment. And as the name implies, this is where we break down some basic options concepts for you, the advisor and the asset manager. And as we were planning today's show, we were thinking about what topics would be really interesting for the advisor right now. What options topics are really top of mind right now for the asset manager, for the advisor? And we kept coming back to volatility. And that really is a hot topic of discussion right now. We're seeing it bandied about everywhere in the broad financial media. Volatility / the VIX, often referred to as the VIX in many areas, who perhaps don't know any better. But volatility and the fact that perhaps volatility is low is a recurring theme in a lot of the financial media out there right now. So we thought we'd really get into that and just explore what that means from an options perspective and how that could impact you when you're implementing your options strategy. So first off, let's take a step back. A lot of you who may be new to our program perhaps missed our earlier segment where we talked about the Greeks. If that is indeed the case, I encourage you to go back and download that segment, because we talk about the 4 fundamental characteristics that make up an options price and also make up the options risk metrics overall. And one of those is one of the key risk metrics, one of the key Greeks, and perhaps many people would view it as the king of the Greeks perhaps, is of course Vega, which measures your volatility risk in your portfolio. And if you remember from that show, of course, we talked about how Vega and volatility really are the fudge factor, for lack of a better word, in an options price. We talked about how options have extrinsic and intrinsic value, the intrinsic value being the meat on the bones, the actual worth of an option, whereas the rest is fluff, interest rate premium, and a lot of volatility premium. And volatility really is the largest component of that fluff. So when people are talking about options being cheap or expensive, they're usually referring to that inflated or decreased level of options volatility premium that is being priced into the option. Now, when we're talking about volatility, there's really 2 types of volatility that we refer to most frequently here in the options market. There's implied and there's historical. Implied is pretty straightforward. It's the level of volatility, I should say, that is being implied by the actual price of an option. So if you look at an options price and you see here's the intrinsic value of that option, and then here's what's left over, you can break down the different components. Interest rates being a typically fixed component right now, usually hovering around 0. They're not really much of a factor in option pricing right now. So really the rest of that premium is usually made up of the volatility component. So if you back that out into your equation, you could see what actual volatility level the market is predicting going forward in the implied volatility. Of course, the other component being historical or realized volatility. That's much more straightforward. That is essentially just the actual level of volatility that was exhibited by the marketplace over whatever time period you're looking at. If you look at the S&P over the last 20 days and look at the last 20 days worth of historical or realized volatility, you can see exactly how much that underlying moved versus what the market was expecting in the implied. And what you typically find in those 2 is that implied usually trades at a dramatic premium to the actual or realized volatility. It's because, for many reasons, not the least of which the fact that the market is not exactly, it's a very difficult proposition to actually predict volatility accurately, which is why there's usually such a discrepancy between implied vol and realized vol. Now, what does this mean for you, the options trader? The implied versus realized, what does it mean in terms of low versus high? Well, what we're talking about when volatility levels are relatively low, that certainly has an impact on your trading. And particularly when you're looking at a lot of what a lot of our advisors do when they come to the options market, they buy protective puts, they construct collars, they write covered calls. Those are the 3 primary trades that they engage in, and those are certainly impacted very directly by volatility levels. For example, when volatility is low, it certainly is much cheaper to go out and buy that defensive protection, those downside puts, those put spreads that allow you to hedge your portfolio. Of course, the reverse is also true. If you're writing options for income, if you're selling covered calls, then it's much more difficult to actually generate income because the risk-reward equation is dramatically out of whack, because the amount of money you're actually capturing or collecting to sell those options is reduced because you're in a low volatility environment. You can flip that around for a high volatility environment. When volatility is high, the amount of income, the amount of premium you're collecting for selling options is increased, but of course is also going to cost you much more to actually buy protection for your portfolio. So volatility is a very interesting topic, and also a very important one when you're looking at constructing your own portfolios and hedging, of course, those portfolios. Now, Randy, you do a lot of hedging of portfolios out there at Swan. You have any notes you want to share with our audience here about, just the overall impact of volatility on options and on their performance, and B, the impact of low versus high volatility environments on your options trading?
Absolutely. I'd like to go through maybe a couple of examples of some research I did this last week with respect to our portfolios. To give you an example, I think over the last 15 plus years, we typically employ buying 2-year put options on the S&P 500 and try to capture, historically we've captured about 65% of the upside in markets that are up years. And to give you an example of the last year's upside capture ratio, we were in about 30, and that can be primarily explained with the decline in the market implied volatility for the 2-year put option that we purchased at the end of 2011 versus what we ended up purchasing at the end of 2012. So that's a good example of the fluctuation in what volatility can do to your hedging costs.
Yeah, that's a perfect and real-world example there. You're focusing on a lot of 2-year out put options, and of course, as volatility levels fluctuate and as the put prices rise and fall, that tends to have a dramatic impact on the overall performance of your portfolio and how much of the upside you can participate in and capture just off of the prices of these protective puts that you're purchasing for your portfolio. And try saying that 5 times fast. Protective puts that you're purchasing for your portfolio. It's a very mouthful of a sentence. But Alan, I know you spend a lot of time working with advisors on these very concepts. So what is some of the feedback you hear from the advisors when you talk to them? And what are some of the key talking points you make sure to hit with them when you're discussing volatility with advisors and asset managers?
Well, as you stated, Mark, volatility is considered the most influential pricing factor, and we try to explain to advisors that the greatest impact in dollars on option value, it's the greatest impact in dollars on option values possible, and it changes intraday. The other thing that we try to expound upon is that the increase in the implied or the Vega amount does not necessarily require a change in the stock price. You can see implied volatility rise and fall with no perceived change in the stock price, which is very hard for people to really understand, but that is a measure of the market's perceived risk.
Yes, it's not one of these more tangible factors that you can easily wrap your head around, like underlying movement, things like that. You could easily see, well, the underlying moved this much, this option has this delta, it gained or lost this much in price from that movement. That's something people can wrap their heads around very easily. But fluctuations in volatility, particularly on an intraday basis, and their overall impact on an option's price can be far more nebulous, far more difficult to wrap your head around particularly when you're coming to options for the first time or thinking about adding them to your portfolio for the first time. It's usually a difficult hurdle for a lot of newcomers to wrap their heads around. Now, we talked about the impact of vol in a high vol environment, impact of vol in a low vol environment in terms of how it directly impacts your trading and the option prices that you're buying and selling. Of course, that is a major component to the overall returns of your portfolio. But there's another reason I wanted to talk about volatility today, and that is because it really directly ties into perhaps the number one complaint I'm certainly hearing from a lot of advisors in and around the option space these days. Alan, I'm sure you're hearing this as well from a lot of the advisors you work with, and that is correlation. Essentially, we're seeing a growing and perhaps even alarming degree of correlation across multiple asset classes. Now, it was in the old days when I took my econ classes and finance classes back in college, you were taught efficient market theory, portfolio theory, and how if you essentially diversified into 10 or 20 different equities in your portfolio, you were considered for the most part fully diversified. If you wanted to get really crazy, perhaps you added in a precious metal or some other fixed income type asset, and then you were beyond diversified. You were really in another realm when it came to portfolio protection. That is no longer the case today. In fact, I was at a conference recently. I won't say the name of it. I don't want to disparage them, but it was a big advisor conference, and they were talking about the old days of having 20 or so equities in your portfolio and being fully diversified. And now if you look at the correlation rates in the cross marketplaces, it really is 40 or more different equities you have to have in your portfolio in order to be considered quote unquote fully diversified, which is of course absurd. Once you start getting to that level of different holdings in your portfolio in order to be quote unquote protected or diversified, you're really chasing a fool's errand at that point. You're adding just more underlyings that are essentially correlated, which doesn't really help you much in the long run. So what we're coming back to time and again, and a key point I really want to stress for this audience, that in this environment, in this market right now, there really is no way to truly be fully diversified, to truly be fully protected against a lot of these underlying swings, unless you have some sort of volatility component to your portfolio. That could come from simply buying an option to hedge or incorporating some sort of option volatility exposure in your portfolio. That way it could come from an overlay. We'll discuss those in a minute, in which you add that to your portfolio, or it could come even from trading some of these designated volatility products out there, like a VIX future or a VIX option or something along those lines. There's a lot of different ways to get the volatility exposure in your portfolio, but the key takeaway from this is that you need it, regardless of what you're trading, regardless of how many underlyings you have in there. The only way to really hedge that and protect that in this environment is to have some sort of volatility asset, like an option, like a future, like some sort of derivative component that can provide that sort of hedging and protection in this environment. Now, Randy, I know you work a lot with advisors out there. You offer a lot of different sub-advisory services to them over at Swan. I'm sure this must be a very frequent complaint you hear, and an issue you strive to address is how to really provide that sort of protection in this environment where everything is so closely linked and so closely correlated. So what do you say and what do you do when these advisors come to you with this issue?
Well, I address the issues, and you said it earlier, that market risk is very hard to diversify away from. And so the options, and our preference would be using long options, long put options to protect portfolios, to reduce the beta of the portfolio, away from one. And that's really, we think, the best way to do it. Obviously, like you said, using VIX options or futures are another way to do that. But I think primarily for the most of the advisors that are coming into this space or even considering using options, I think the concept of VIX may be a little over their head to begin with. So I think the put concept is much more basic to them, the concept of insuring your portfolio, because as of course we insure almost every aspect of our life, and we always throw out, why not your portfolio? So we like the concept of protective puts in that. Of course, when you buy protective puts, you like to do other things to offset some of the risk of buying those protective puts, and that revolves around other income types trades or spread orders to lower some of maybe your volatility exposure.
Well, I certainly agree on VIX. I think we'll hit on that more in a second, but it is, you're right, a very complicated product for a lot of people to wrap their heads around. But you're right, there are a lot of ways to get that exposure. And now, Alan, you certainly deal day in and day out with this advisor audience. You're talking to advisors every day. You're getting the feedback from them. I know from speaking with you in the past that correlation is very much a big issue that they're looking to you to address. So what do you say to advisors when they come to you with questions about how do I get around this correlation issue? How can I use options to circumnavigate the issue of all my underlyings essentially moving in lockstep?
Well, I think you hit the nail on the head. You have to have something that's intrinsically inverted to a long-only portfolio. And I think, the buzzword now is diversification of assets is not necessarily diversification of risk. And when you have a long-only portfolio across many different asset classes, what you're seeing is that when the market does go into a high volatility state, that many of these assets move down in lockstep. They all fall at the same rate of speed or near the same rate of speed or an 80% correlation, however you like. But a long put short call is by its nature inverted to a long portfolio. So you get 100%, provided you're using the right put and the right call, you're getting 100% inverted risk to the long portfolio. And that's what we teach them. We teach them how to do just basic puts against a portfolio, and a simple strategy is to buy SPX puts against the construct of a similarly constructed S&P 500 portfolio, which they can do very simply. It's what we call a loose hedge, right? Because you have basis risk amongst the stocks that are not comprised in the client's portfolio. If he only has, say, 150 of the names of the 500 that make up the S&P 500, there's going to be some variation as to whether he's underhedged or overhedged by buying SPX puts, but it works as well as anything to protect yourself on the downside. And I think that's an easy way to do it. And you have those that are reluctant to buy puts. Most advisors will say, look, I don't want to buy puts. It's a drag on the portfolio returns if the market stands still. And, of course, that's true. But there's ways to either do a put spread to reduce the cost of that transaction, or to do a collar, to sell a call to finance the cost of that put.
Mark, I just wanted to add one comment to that. We're very familiar with this strategy because that's what the defined risk strategy is all about. And my experience over the 15 and a half years of doing this is that the cost of buying our puts in terms of our actual experience over that time period has been actually pretty minimal. And it's been a very good risk reward ratio in terms of the protection we've offered our clients and our advisors in down markets versus what the concept of what you theoretically may have to pay. Of course, we all know in an up market, your costs are going to be higher, and you will have some costs in a flat market, assuming, of course, volatility does not change over that time period. But overall, I think it's a concept that we've been successful with, and we think we'll continue to be successful with. And in terms of, we haven't gotten into just the general overall volatility right now in the market, but just in our experience over the last year, we've seen volatility drop a little more. And of course, now we think it's even a better time to be hedging our clients' portfolios, new clients that are coming in right now at this level of VIX. I know it's not extremely low over the last 50 years per se, but definitely over the last 7 years, it's been a good, it now seems like a good time to be more considering hedging.
And you're right. It is an interesting time for this. And I think if we can convey one sentiment to our audience, one takeaway that they can take away from listening to the advisor's option, that this is indeed a course of action that they want to pursue. And if we can arm you with at least enough information to make you confident to go out there and perhaps pursue more information on this, and eventually get yourself to the point where you feel comfortable hedging your portfolio by buying a downside put. Could be the simple, straightforward S&P 500 example that Alan laid out, or some other things like that. Perhaps you're trading in a very concentrated equity position like an Apple or some other areas, and you want to hedge that risk. It's a very simple procedure to actually go out and do that. And then perhaps you can graduate to the strategy we illuminated on a recent episode, the collar, that Alan also touched on, which is a very popular strategy with advisors for the reason he outlined. Essentially, that allows you to minimize the outlay you're spending for your protection. And of course, it's an interesting point overall. I know probably 4 or 5 years ago, prior to the 08-09 meltdown, it was a difficult concept to get a lot of advisors and asset managers to outlay any money at all for protection. They couldn't wrap their heads around that. It just didn't seem anathema to them to spend money and give up basis points that are so precious to them to protect their portfolio. And now, post 08-09, when we see people talking about ridiculous things like adding 40 or more underlyings to your portfolio to protect yourself, I think a lot of the savvier ones are starting to realize that and say, wait a minute, there must be a better way to do this, a much more effective way than just adding more names to my portfolio or trying to be more defensive in my stock selection. At the end of the day, that's all a crapshoot, whereas adding some sort of hedging derivative component like an option, a protective put spread, is a much more quantifiable and demonstrably effective way to go about that. So let's talk about that for a second. How do you get volatility exposure in your portfolio. Randy and Alan outlined several ways already. I think a lot of us like to really prefer the downside protective put. It's a great starting point for a lot of advisors, but of course, a lot of them have also issues outlaying, or they want to reduce the amount of premium they pay for their protection, so they like to add the selling component, whether it's a put spread, where they're selling a farther out of the money spread to reduce their net outlay, or they're turning to the upside and selling a covered call to reduce the overall outlay for that protection. Either way, that's a great way. I think it's worth hitting on it really quick, and maybe, Randy, I'll ask you to expound on this because this is very much your bailiwick as opposed to mine. A lot of advisors come to us and they're concerned because they've created this optimal portfolio, and now they're afraid that they have to change the construction of their portfolio in order to really hedge it effectively. And the answer to that, particularly if they're not sophisticated enough or confident enough to hedge it themselves, is you can make end runs around that. And one way to do that is something called an overlay, where you go out and buy options and essentially overlay them on your existing portfolio. And this is a very popular strategy for a lot of advisors to sub-advisor out, because essentially it allows them to do and keep doing what they like to do and what they're best at, which is perhaps asset selection, asset allocation, and allow someone else to construct a meaningful, cost-effective hedge to protect that allocation. So Randy, why don't you give us a couple quick notes here on what an overlay actually is and how you go about constructing those for our advisors who may be interested in pursuing that as well.
Sure. The overall concept, as you said, Mark, is taking an existing portfolio and overlaying on top of that various components of using options, whether that's buying protective puts, engaging in various option income strategies. We always, when we have discussions with our advisors when they come to us, is we say, look, the concept of portfolio management, modern portfolio theory, it's great. It's not the complete story. It's only part of the solution. The missing piece, we believe, is the components of adding options to the portfolio. So we think we can effectively add on top of on what an advisor is doing or another money manager is doing and provide true value to our clients. And if their underlying portfolios turn out performing as expected, then it's a win-win for everyone. Historically speaking, at Swan, we've been able to more than offset the cost of the annual hedging costs with our option income strategies. So, net for us, we look at it as an additive strategy that's not just looking at trying to minimize losses. I would, however, add that, from a true portfolio perspective, the concept of hedging is it's okay if you underperform on the upside if you also outperform on the downside. So from a just a portfolio view, I would always add that what you really want is a consistent return, that the standard deviation of those returns is pretty close around an average number, as opposed to being up 30% one year and down 30% the other. Well, most of our clients and our advisors would prefer a return that's 7 to 10% consistently than huge up years and down years. So even if over time the hedging costs kind of average out, I think you theoretically should end up with a better portfolio in terms of standard deviation.
And that's true. The concept of outperforming works both ways, to the upside and to the downside. I'm sure a lot of our listeners who may have been down 30% in 2008 or 2009 would have certainly preferred to be down perhaps 6% instead of 30%. And that's a substantial savings when it comes to overall losses for your portfolio. So if you can participate to most of the upside and also have outperformed to the downside, I think that's a valuable combination for a lot of our listeners.
We have historically, with our composite, achieved about 70% of the upside with about 5% of the downside. So I think that's very much in line with our stuff. I'm actually in the process of writing our quarterly newsletter that people can get off our website probably in the next 2 to 3 weeks, that kind of goes through how historically we've done with our hedging costs and on an annual basis, and how we've done relative to the market. So it's a pretty interesting concept of I really believe that people are overstating the actual cost over time. Granted, no one knows what's going to happen over the next 20 years. Is there going to be a 20-year bull market? Obviously, if there's a repeat over the last 10 or 15 years, then hedging is the only way to go.
And there you go. A lot of people are reticent to share actual data on that sort of thing and the impact of hedging and the cost of hedging and the impact on performance. But Randy and the boys over at Swan are not afraid to share some of those numbers. So if you want to check those out or maybe check out Randy's forthcoming newsletter, then just surf on over to swanwealthadvisors.com. Of course, you can also find it on the Advisors Option landing page on the optionsinsider.com. We'll point you over there as well. So interesting stuff to take a look at, particularly if you're an advisor and you're looking to arm yourself with some specific numbers to discuss with your clients and some research to back up some of your own analysis on this subject. Speaking of analysis of this subject, Randy's touched on it several times now. No discussion of volatility in this environment would be complete without at least touching upon the VIX. I do this somewhat reluctantly. I think VIX is really bandied about far more often than it should be. It gets a lot of play in the media. You can't turn on CNBC or Bloomberg and the other outlets without really hearing about the fear gauge on a regular basis. And it's a very intricate topic. It's a very confusing topic for a lot of new advisors, precisely because it is complicated, A, and B, it's not really understood very well by the media who discusses it, and so they create perhaps an inaccurate perception in the minds of the investors. So I think really quick, I want to run through a couple of common misperceptions that we've encountered with advisors who are interested in learning more about trading the VIX. First off, probably the number one misperception we see with people talking about the VIX is, and that partly is not their fault. This is how the media addresses it. Whenever you see this VIX quoted in the media, they're often quoting VIX as trading at its lowest levels, blah, 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 blah. They're quoting the VIX cash index. And what that is essentially a meaningless abstract number. It's compiled from the front month implied volatility of the S&P 500 options on the CBOE. And what that number itself is meaningless because in reality there are no products that trade off of that. The actual trading price of the VIX is pulled from the price of the front month future in the VIX, and that value is determined, like I said, from the implied volatility of S&P 500 options over at the CBOE. So while talking about the VIX cash is maybe informative in a general way, it's not really actionable. And I think a great example of that is a few months back when the VIX cash broke in the 13 level for the first time. We saw a lot of the media really talking about VIX at record low levels, VIX at record low levels. But if you actually went and looked in the VIX futures market, which show you the actual price you'd be paying, the actual volatility levels you would be buying if you want to actually go out and buy VIX as some sort of protective or hedging instrument, the actual front month future was trading around 26 to 28, which was in the range of post Bear Stearns, post Lehman meltdown in that marketplace environment. So that gives you a better sense of what the market is actually pricing in and expecting versus this somewhat abstract VIX cash number that doesn't really tell you a lot. So the first definite point I would stress is that be aware of the VIX cash and actually go out and look at the futures and where they're trading, because if you're looking at VIX options, that's where the prices are going to be derived from those futures levels, not the cash. So don't expect to see a VIX cash trading around 12 and expect your options to be pricing off that level, because they are not. That's number one. Number two is this perception, Randy's discussed it, other people have discussed it on our shows and many shows on our network in the past, this perception that is very pervasive right now that VIX in general is low. And like I said before, that's a bit of a subjective term. Obviously, it really depends on the frame of reference you have when you're looking at it. Of course, when I was standing out in the S&P pit in the late 90s, early 2000s, a front month at the money implied volatility of the S&P around 12 to mid-teens was actually somewhat high. You got into the high teens, that was seen to be somewhat high. Right now, we're in a different frame of reference. We're post-2008, post-2009. The VIX cash gapped up all the way to over 80. So people are looking at that frame of reference now and seeing a VIX in the mid to low teens is actually being low. When if you look a little bit farther back, certainly the frame of reference changes. Also bear in mind exactly the VIX cash meaningless abstract number. Really look where the futures are, because as that example I just showed you, when the VIX cash hit 13, the actual price you were paying for, or the actual trading level that you were keying off of in your VIX options, was substantially higher. Last, I think, but not least, this is an important point to stress as well. A lot of people think of the VIX, and somewhat because of how it's been marketed, somewhat because of how it's perceived in the broad media, it's this fantastic inverse correlation portfolio hedging tool. So instead of going out and buying a more direct portfolio hedge, like a downside put and some of the strategies we've illuminated on the show already today, they'll go out instead and buy a VIX upside call and expect that to perform the same. And it's important to stress that they are not the same thing, not by a long shot. The VIX is a very intricate beast. It moves, has a lot of factors that drive its movement and its performance, not just where the underlying is going. If, for example, you could have a day where the underlying is drifting down and you might have a VIX upside call. You might expect the VIX to rally, but if the underlying is drifting down slowly and perhaps a lot of people are out there selling options in the S&P 500 pit and selling premium out there, guess what? Overall, the VIX is going to decline and your hedge is not exactly going to perform very well in that environment. So it's definitely worth keeping that in mind, that it's not exactly a locked-in one-to-one inverse correlation. It's going to change and fluctuate based on a lot of different factors. A lot of the structured products that exist around the S&P 500 and the VIX right now have a lot of impact on where the VIX is, and a lot of these ETFs and a lot of other issues that are causing a lot of different paper flows going into this product that are somewhat confusing the overall environment somewhat. So if you're going out expecting VIX to perform as this perfect one-to-one inverse correlation, do not. That's not to say it's not a good product or that it shouldn't be used. It's just you keep in mind what it actually is. And we see a lot of people doing some combinations of perhaps downside put spreads or puts with perhaps a VIX upside call kicker to add a little bit extra boom, because in the day-to-day fluctuations, VIX tends not to perform that well, but in these explosive environments where there's I hate to use the oft overused cliche, but it's a black swan type environment where the market is truly melting down aggressively, VIX products tend to outperform in that scenario. So there are use cases for them. It's just not perhaps what a lot of people would expect. Oh, quick note too, I want to mention on structured products, and Randy or Alan, you guys can jump in on this as well. I think one of our goals with this show too is to hopefully steer a lot of our listeners away from some of these more esoteric products that are floating around out there. We've seen a lot of advisors falling prey to this who, for whatever reason, lack the sophistication or the knowledge on the options perspective, or in many cases, they've been trained through their certification exams and through their other training materials to just like structured products. They're easy to incorporate into their portfolio. They're used to just to giving them to their clients, either high load or no load funds or whatever the case may be. They're used to dealing with those types of products. So just going out and buying another product that can offer some sort of hedging power, some sort of hedging effect to their portfolio, or perhaps some volatility exposure, it sounds like a good deal to them. But it's really important to read the fine print on these products, because so many of them underperform actually creating the product yourself, and of course they charge you substantial fees to do that. So Alan or Randy, any final words on structured products or anything like that before we wrap up volatility here?
Well, I would say the one point is that, they do have their place, Mark, for sophisticated investors, but they need to be aware of that many structured products are contracts that are guaranteed by the banks that issue them. And in the cases where banks have defaulted, and we've seen cases where we had Lehman and Bear Stearns go under, you can have a problem if you own a structured product that's issued by an entity that's heading into bankruptcy. So they need to know that. Fees are always an issue. I can tell you, even on the pension side of the equation, if you look across the nation at the pension crisis that exists currently with underfunded pensions, if you do a deep dive into a lot of portfolios, you'll see that they're paying high dollars in fees for many of these products. Now, just to be clear, a structured product can exactly mimic essentially what Randy does with his portfolio. It'll say, I will give you 70% of the upside, and I will protect you on 80% of the downside risk. And so you essentially are giving you an all-in-one tool of what Randy is currently doing through his portfolio.
My only comment on the structured products is be careful not to get a structured product that structures all the profit out of it. So, we try to tell our clients is you want to have some risk. If someone has to go to the extreme to structure it so much, then they've got to build in a bunch of contingencies on their side. So you probably won't have as much as the upside over time. Obviously, in certain environments, I think they're good products. I do, Mark, have a comment about one of your comments on the VIX. One of my fears of hedging with VIX or any type of derivative or VIX product would be a sell-off that occurs over time where VIX really doesn't spike very much, or it spikes initially and then 3 months later the market's exactly where it was after it sold off 15%, and the VIX drops over time and you lose that benefit. So that's one of the concerns I would have with using just VIX products. But supplementing VIX supplementing your long put or your put spread with other VIX trades, I think is a good concept.
Yeah, that's why I didn't want to get into it too much because it is such an intricate topic, you're right. But that is exactly one of the types of scenarios that I was referring to where just hedging with VIX alone is not ideal in that scenario. And a lot of people who might come to it and use that as their only means of portfolio hedging, if they were to encounter a scenario like that, I think they would be quite underwhelmed with their performance of their hedge. That's why we typically, I personally, I know a lot of the people on our other shows, on this show as well, I think for the most part tend to prefer, particularly for this audience, the advisors and some of the newcomers to the options market, that they stick with the more direct types of hedges like the downside put spreads. Maybe they offset it with a collar. And then if they get a little more sophisticated, they can start adding some other components like a VIX upside call as I pretty much, instead of calling it a hedge, I think of it more as a kicker because it adds that extra benefit. If you're willing to outlay some basis points for it, it can add a lot of benefit in an extreme downside scenario. Just don't count on it to be your day-to-day protection because that's really not what VIX is suited for. Okay, and just to wrap up here on the volatility subject and to close out our Options 101 segment here, we wanted to touch on this because it is such an important topic. It is top of mind for so many advisors right now, and it's also quite frequently a very misunderstood topic. So we wanted to be sure to outline some of the key elements of volatility when you're trading. So let's just run them down again really quick. Volatility, Vega measures the overall impact of volatility on an options price. So volatility can be a very substantial component of an options price. It could be the difference between an option trading a dime and a dollar, everything else being equal if you're in a very volatile environment. So it's certainly something to pay attention of. We hear this refrain quite a bit from some advisors and a lot of other newcomers to the option space who say, well, I don't really need to be aware of volatility because I'm doing simple stuff. I'm just buying puts. I'm just selling covered calls. I don't really need to pay attention to volatility. And that's, of course, demonstrably false. Really, if you're doing even those simple strategies, you still have a substantial amount of volatility exposure. And it's, of course, dictating how much you pay for those options or how much you're collecting when you're selling those options. So either side of the coin, whichever way you fall, buying or selling, volatility has an important role overall. And of course, if you're looking for correlation, if you're one of these advisors who is struggling with the correlation issue right now, there's really nowhere else for you to go than to add some sort of volatility exposure to your portfolio. Could be buying a simple protective put, could be constructing a collar, could be constructing a much more elaborate overlay. It could be, we don't recommend it, but you could start dabbling and perhaps in some of those volatility type products as well. Just be careful where you go in that scenario. Watch out for some of these crazy structured products. And certainly if you're going to dive into VIX, don't rely on it perhaps as your day-to-day hedge, but perhaps as more of an extra bonus perhaps in some of these very dramatic environments. So there you go, an overall review of volatility and how important it is to you, the financial advisor who's looking to incorporate options into your portfolio. And that's going to do it for our Options 101 segment. And now we're going to roll right into our Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzzed.
All right, and welcome to The Buzz. This is, of course, the portion of the program where we break down some interesting developments, some interesting news that is going on in the world of options that can dramatically impact you, the advisor, but of course, a lot of advisors and asset managers, very busy people, they don't have time to pay attention to all the developments and all the different market sectors that they may be interested in. So we try to do that here for you on the Advisor's Option. And there's certainly been a lot of developments in the world of options that will have a substantial impact, or should I say, could potentially have a substantial impact on you, the advisor. And Alan, our good friend over here at OIC, has been keeping tabs of one of them in particular very closely. So Alan, why don't you lay out a bit some of these potential taxes that might be looming on the horizon for options traders?
Well, thank you, Mark. Yes, I think investors need to be aware of that there is a proposal now from Representative Dave Camp, who's the chairman of the House Ways and Means Committee, and his proposal is talking directly about recognizing the gains and losses each year on options and derivatives, and they would be treated as ordinary income rates regardless of whether they dispose of the asset or if they even close out the position. So rather than go into it blow by blow, I would encourage our listeners here to take a look at what that proposal is and speak to your representative about it, because I think it's a dramatic overhaul of the current tax situation, and I don't look at it as being favorable at all to those who use options, even in a covered call or protective put sense. So that's the key point of the day, I think, is familiarize yourself with what that proposal is and reach out to your representative and see if you can't voice your opinion.
Yeah, that's a terrifying prospect, I think, to a lot of our listeners, the notion that they can just write a call on some underlying they have, and then all of a sudden they're immediately considered as having divested of that asset from a tax perspective, even though that call could expire completely worthless. That's a very, very bizarre proposal, I think. For that obviously smacks of someone writing that who saw an opportunity and perhaps wasn't fully cognizant of how this marketplace works, which we're used to here in the options realm. A lot of regulation coming our way that may or may not actually understand the product it purports to regulate. I won't put words in your mouth, Alan. I'll just say that myself.
Okay, that's fine. Yeah.
Randy, anything to add on the tax issue here?
No, I think I agree with Alan. That would be very disappointing if that would happen. I think that would change some of the dynamics of what we do. I hope that doesn't pass. I do have another different related item. Right now we're in discussions with TD Ameritrade to start having a monthly options seminar going around the country, and I would be one of the participants in that. And so it's really geared towards getting 20, 30 advisors in a room on a monthly basis in different cities around the country to give them an overview of the options market and how they can use it in their practice. And so we would be part of the resources that people would be able to use and learn from to see whether or not they would like to delve into this industry.
Do you know where advisors can go to find out more about that if they want to perhaps sign up for a seminar or see when they're coming to a town near them?
I think the best thing to do is to maybe contact me, send me an email, and then as I get this developed more, I can send out anyone that has a request for a certain city.
And your email is listed in the intro. Remind our listeners what it is again.
It's randy.swan@swanwealthadvisors.com. I believe our first conference or meeting is going to be the end of this month in Atlanta. I think it's the last Wednesday.
There you
of the
go,
month.
Listeners. If you're looking to learn more about these products in person, or just want to meet Randy and chat with him off the show, then this is your opportunity. So shoot Randy an email, and he'll provide you with some of the logistics in terms of when that tour is coming to a town near you. And that's going to do it for the Buzz segment, and unfortunately, that's all the time we have for this episode of the Advisor's Option. I, of course, want to thank both of my co-hosts here, my partners in crime. And Alan, perhaps we'll start with you. Before we go, are there any upcoming developments over at OCC or just maybe in the industry in general that you think are interesting? Maybe any seminars for advisors you have coming up over there at OIC that you may want to let our listeners know about?
Well, yes, Mark. We just posted all our upcoming seminars and events for calendar year 2013 just about a week ago. And next up on the plate are a basic and intermediate presentation that will take place in Tempe, Arizona. You can go on there and register for free on the site. And, of course, all of the lectures are gratis. There's no cost whatsoever to attend. For me, I'll be speaking next Tuesday, March the 5th here in Chicago, and I'll be doing an advanced seminar on the Greeks. So for those of you who are intrigued by today's Vega episode, we'll do a deep dive into Vega as well as all the other Greeks. And I think when you come out of that lecture, you'll be very, very well informed on the backbone of the option pricing model.
There you go, Alan. Very timely stuff, diving deep into the Greeks right after we finish up discussing volatility. And of course, if you want to find out more about those seminars that Alan is referring to, you can surf on over to optionseducation.org. Or, of course, you can find the link in the show notes on theoptionsinsider.com. Either way, they'll point you towards all that great stuff that Alan was just referring to. And last, but certainly not least, Randy, I think you already hit the nail on the head when you mentioned your upcoming tour. But perhaps, concert tour aside, is there anything else coming up in the land of Swan Wealth Advisors that you think would interest our listening audience?
No, just other than an announcement that I think this week we hit our $500 million of AUM, so that's a kind of a milestone for us. And one of the things that is coming up is that we're in the process of of getting some institutional type money at that level. So we're pretty excited about that to expand our reign of who we're offering business to.
Well, great. Congratulations on that. I know that's a substantial milestone, and certainly that'll open a lot of doors for some new investors to come your way and benefit from some of the overlay and risk mitigation strategies that I know you guys love over there at Swan Wealth Advisors. And of course, we encourage all of you out there in the listening audience, whether you'd like to listen to some archived episodes of this program or any other program on the Options Insider Radio Network, or if you'd like to learn more about any of the topics we discussed on the program today, then by all means surf on over to theoptionsinsider.com. You can find all of that, plus breaking news from the options market, unusual activity alerts, education, analysis, pretty much anything you could hope to find from the world of options. We have something on the site somewhere for you. So it's quite an expansive archive of options information. We've been running for 6+ years now, and I was just perusing it the other day, and it's just it's amazing how much stuff we've encapsulated there on the archive. Not even getting into all the different shows we've been running for also over 6 years now on the Options Insider Radio Network. So a lot of great content waiting for you over there. If you like anything we discuss on the show today, you can find out more about those topics over on theoptionsinsider.com. You can also use our comment system or to shoot us an email, questions@theoptionsinsider.com. Just be sure to put the subject line advisor's option question in the subject line if you'd like to send us a question for this show. We'd love to hear from you, the listeners, and see what kind of questions you guys have and what topics and information you'd like us to discuss on future episodes of the Advisor's Option. You can also find us on Twitter. We're just at Options on Twitter or on Facebook. A lot of ways to get in touch with us here on the Advisor's Option and make your voices heard. So on behalf of all of us here on the Advisor's Option panel, we'd like to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.